So we have a very traditional question in this paper is that we seek to understand why, especially in emerging markets, dollar credit is so predominant. What makes this puzzling is that regardless of the fact that it's well known that dollar credit is connected with economic crisis and regulators try to impose policies to discourage it, we still see a large volume of credit being voiced in dollars in emerging economies. So in this paper, we're going to use this novel data set for Peru, a heavily dollarized emerging market, to further understand the forces behind corporate credit dollarization. Our data set is going to allow us to measure the size of the dollar discount and trace its sources by looking closely at the bank's balance sheet and the bank's regulation. So let me tell you a little bit about our main findings. So first, we find that in line with anecdotal and survey evidence, firms borrow in dollars because it's cheaper. Using this novel data set that includes interest rate on loans, we're able to quantify the magnitude of the discount on the dollar loan. And the answer we get is this 2%. So dollar is going to be 2% cheaper. Just to put this number in perspective, borrowing in local currency, which is the soles, is 7% interest rate on average. For dollar is 5%. So it's about 30% cheaper, this 2% discount. And this is going to be true even after we adjust for expected exchange rate movements. So indeed, it is not only cheaper in terms of interest rates, but also once we adjust for expected exchange rates, it ends up being cheaper to have been borrowing in dollars than in soles. The results are going to be very robust to an array of loan and firm controls, and we're going to show very stable over our sample. Second part of the paper, we're going to start digging into what's making these dollar being so much cheaper than soles. What's making these loan interest rates being lower. And we're going to explore policy changes to connect the explanation that ties dollar borrowing and dollar discount to the local preference for dollar savings. So it's going to be cheaper to borrow in dollars because for the bank, in terms of deposits, it's cheaper to finance with dollars. Right, so dollar deposits are going to be strongly preferred and compose 60 to 70% of the bank's dollar liabilities. Depositors are going to be inelastic and are going to be willing to take a big discount to deposit rates to keep their savings in dollars. The fact that the dollar financing for banks is so cheaply priced, together with banking regulation that does not allow banks to hold a mismatched balance sheet in terms of currency, it's going to lead to banks passing through the discount that they see in the deposit market into the borrowers. And this is going to be at the core of the cheapness of the dollar and the dollar dominance, right? Why do we see so many dollar loans? Is because dollar is much cheaper, and dollar is much cheaper because people want to has this preference for saving in dollars. So let me help you place our findings in the literature. So we relate to several strands of literature. Here I'm going to highlight a few papers on this massive literature. So we're going to expand this corporate trade literature of firms borrowing in foreign currency because it's cheaper. Our benefit is that we observe interest rates. We're going to use loan level interest rates, which is a rarity in this type of literature. I myself have contributed to it, and usually we just see, credit registry. We don't see rates. Here we see rates. We're actually able to quantify and give a number to the level of cheapness of the dollar. So it's like a granular level of the UIP deviation coming from the banking sector, which is something that usually we don't observe. And this is this 2% first contribution that we give. Second, some of the discount can be connected to a dollar convenience yield, but usually direct measures of convenience yield usually arrive at much lower numbers. These two papers are new structural estimations of the dollar convenience yield. They use general government financing rates and show that this yield is higher, like the convenience yield is higher, closer to this 2% we see. What we contribute to this literature is that our numbers suggest that the forces that are at work for emerging markets is actually a local preference for a dollar savings. So it's not actually coming from a government risk type of perspective, but it's coming from a local preference for dollar savings driving these 2% rates. We're also connected to the bank balance sheet literature that highlights the importance of global banks and financial cycles. We do not find a strong role for international flows and global banks. Local and foreign banks have similar shares of dollar deposits and deposit rates. Furthermore, our interest rate data allows us to explain bank behavior and connect the dollar discount to the deposit differential. So not only we're looking at quantities, but we're looking at prices, and we think that prices are a key to understand quantities here. And then we see that it's not coming actually for global funding or any type of this type of discussion. Finally, we give empirical support to the theory proposed by Boccoli and Lorenzoni that traces dollar loans to the desire of dollar insurance from depositors. What we also contribute to this literature is that we highlight the importance of the intermediaries regulation, so the balance sheet of the bank's regulation, into having this transmission. So as I already signaled, this is going to be mostly an empirical paper. So let me give you details on the data we're going to use. So we have several sources of data. What's important to remember is that this is Peruvian data. For what we want to know, which is dollarization, Peru is a representative country in terms of the dollarization of deposits and the type of monitoring policies put in place. We'll also show you some statistics for other Latin American countries and make the point that what we observe for Peru seems to generalize for all the countries that allow this type of dual currency in their deposit and loans banking sector. The most important piece of data is that we observe interest rates on loans in local currency, which is soles, and foreign currency, which is US dollar. Although there's no restriction on what currencies banks can give loans in, these are the only two currencies that we observe that banks are actually giving loans or firms are taking loans in. Data-wise, this is going to be the main innovation of our paper. We see loan level interest rates between 2012 and 2018. And this is going to be, as already pointed, kind of different from the traditional type of data that we usually work with, which is credit registry data. I myself have worked with this data set for countries like Hungary. But in Hungary, we didn't observe interest rates. So we couldn't tell you, we assumed that it was cheaper to borrow in foreign currency, but actually we couldn't tell you if it was indeed cheaper. Here we see it, so we can actually quantify it, which goes a long way. This additional data on interest rates have been specially collected by the regulation because Peru understands that dollarization is such a concern. We're able to combine these rates with the traditional credit registry data, allowing us to see exactly how these loans are priced. So we see maturities, we see banks who issued it, we see a lot of characteristics that allow us to control and really get a clean level of this data, of this interest rate differential. One last point is that this data is novel and has not been used for academic research before. So let me show you some summary statistics. So our sample are 1.6 million transactions and about 55% of all commercial loans issued in Peru. We observe all loan types, including credit lines, trade credit, letters of credit, and leasing. We're going to focus on commercial loans, which corresponds to over 95% of the total loan value. So we're not going to use the entire 1.6 million observations. We just use commercial loans, but we do robustness, and our results go through if we use all types of loans. All commercial loans have a fixed rate regardless of currency, and there are no upfront or maintenance fees. This table is going to summarize the loan and firm characteristics of dollar and soles. Overall, the two types of loans are quite similar, with the exception of the interest rates. So it's what we see here on the top. As we already told you, the dollar have on average significantly lower rates. This differential is also present when we restrict the sample for only foreign banks. We observe all derivative transactions in Peru, but only about 15% of the firms with dollar loans have a hedged position. So, and many of the times this hedged position, this type of financial derivative, the quantities and maturities do not align. So indeed, as I'm going to show you in a minute, these firms are truly exposed to exchange rate movements or to exchange rate volatility by borrowing in foreign currency, by borrowing in dollars. This, together with what we'll show you next, is going to paint this picture that these firms are truly exposed. So let me show you some statistics on loan dollarization in Peru. So
can I ask you something? Just yes. A quick question, just to clarify a little bit the data. So if a firm applies for a loan, do you know if it is offered a loan in soles or in dollars? Because they look similar, right? The firms. So why we
don't see application. We see only like loans that have been contracted. It'd be interesting to see. My guess is that they go and they say, the story I put in my head is that, you know, when I go to get a house, when I go to buy a house, I usually, you know, quote many different rates of different types of loan, 15 years, 30 years, arms, fixed rate. My guess is that these firms are actually going to the bank and say, hey, if I get this loan or this loan, what would be my rate? And they're making a decision. Yeah, we don't see applications, so we're not able to tell that. We only see actual, this is like a loan level type of database coming from the banking regulator sector in Peru, and it's basically all loans that are in the bank's balance sheet. Someone asked me if I'm gonna have, so I will ask, because it's gonna be really hard for me to see the chat. Sometimes I may miss it. To just stop me if you can. Ask me if I have more data on other dollarized economies. Yes, we do, just to kind of make the point that what we see for Peru is actually true for many other emerging markets. We do have some tables for a lot of emerging market economies. I'll show you one in a minute. But what we see in Peru is actually pretty normal in emerging markets, as most of us know. So in Peru,
can I ask you something?
Yes.
Hi. So I think it's related with Sophia's question. So if it is only 2% the difference,
it's not only 2%, it's 30% of the interest rate actually. So it's significant.
No. Yeah, sure. No, it's significant. I mean, why then there are they borrow in soles? Because if it is only 2% and the firms are the same, then it is and they choose, as you said, then they should choose the dollars always.
Well, some firms so in theory, so if I see this is gonna, I'm gonna show you that this is kind of on average, so it's kind of a risk-free type of sense, right? If I'm a firm and I know that if bad things happen, I default, I'm not gonna borrow in dollars, I'm gonna borrow in soles, right? So this is kind of, if you think about like UIP deviation, what we're kind of talking about usually is what we see is in equilibrium for those firms that chose to borrow, right? And usually those are firms that are going to have a low sensitivity to exchange rate movements.
Okay, so so there are differences because the table show us that they're the same, but
in equilibrium. So what we observe is that for the sample, so this is conditional on the sample, right? So for the sample of firms that borrow in dollars, and for the sample of firms that, like, this conditional on the loans that we observe in dollars and the loans that we observe in soles. If what the data that Sophia was talking about we had, maybe it would be a little different, right? If we had all applications, we would be able to see that the firms that are borrowing, the story that I think is that the firms that were borrowing in soles, their discount is not actually 2%. So there's a selection layer inside this data, right? Because this is granular data.
But that selection is not cannot be identified with the observables, you said.
Correct. With what we observe, we're not able to tell. So I have a different paper that would maybe cater a little bit to what you're discussing. So in a model, in a theoretical model, you can think about the fact that the firms that choose to borrow in foreign currency are going to be those that it's cheaper to borrow foreign currency because they are more productive and less risk prone to risk, right? So then what we are going to be observing in the sample is also going to be the combination of the risk-free rate with also the selection, right? What I'm going to show you in a couple of slides is that it looks like the banks are actually, because they need to, and I'm kind of advancing myself, but I enjoyed the discussion, so sorry if this is, I'm taking this as a regular seminar. What you would see is that if the banks don't price in firm risk, we would still see this, and then the selection would be that you would have a bad selection, which also happens. But there's going to be a point, because what we're going to see in terms of mechanism is that the banks are going to be pushed into making dollar loans. So in the end, they're not going to be pricing as much firm risk as they should.
Okay. And just a quick clarification. The firms may have both, right? In soles and in dollars.
So we will do some within firm analysis, kind of.
But when you classified in the last table the firms that have any of them, then there are firms in both.
So that classification and all of our analysis, it's based on loans. Okay. So we don't do it based on because we could, but that's not the idea here. it's all loan level. So our data set or our analysis is a loan. That's what our observation is.
So,
yeah.
So it may be the case that they are diversifying.
Of course, yes. Okay. There's some firms in our sample. It's not that many, but there's some firms that borrow in the same quarter, in both currencies in the same time. And then we're able to that's a cleaner experiment to see whether it's indeed cheaper. But that's going to be also another selection layer into it.
Juliana, sorry. Yes. Good morning. Have you seen Alianza del Pacífico database?
No.
Okay. So because I don't know if you have some kind of disaggregation here in order to compare to other economies, such as Ecuador, for instance, because Peru, Chile, it's my opinion, it's very different in the economy structure.
So we gathered data from BIS, from the IMF, and maybe this is the same data you're talking about. I'll show you in a minute. Our goal is not to do a cross-sectional, cross-country analysis. It's more like we focus on Peru because we have this granular level of data. But Peru, for like a dollarized economy, is pretty standard, right? Like it's a similar economy. It's heavily dollarized. So economies that allow for dual currency banking sector, I think Peru is pretty representative. But I'll show you, I don't know, I'm happy to hear what data is available also. But our goal here
is beautiful. Alianza del Pacífico, yeah, I think that it's a beautiful data.
Okay, yeah, no, thank you. Yeah, I'll be happy to take a look. So in Peru, during 2018, about 40% of corporate credit was issued in dollars. And this number is going to be consistent with a lot of emerging market economies. So here, let me see. So here we gather some data from the IMF and the IADB. And we see that, you know, the shares of loans and liabilities across countries, it's pretty, on average, we see a lot of the loans also being denominated in foreign currency. We have Chile here. And then we also see that, like, for countries that don't have that many loans or that many deposits, actually we see here Colombia, Brazil, I think Mexico is also, there's some restriction about whether you can have a true dual currency sector. But for many countries that have no restriction in which currency you can deposit in, we see that Peru is pretty representative.
Juliana,
okay. Yes.
Just a clarifying question. When you, something is not clear to me. You're talking about loans that are being taken within Peru, regardless of the currency, or you can also talk about foreign loans that you, let's say, borrow from Banco of America.
So this is banking sector. So literally, like, this is going to be loans issued in the Peruvian banking sector. Either you borrow from, so it's like a bank that it's physically in Peru. Okay. It can be a foreign bank, or like when you think about these banks that have like subsidiaries in Peru, or a local bank that doesn't have a subsidiary abroad. So this is like we call it global banks versus non-global banks. But these are literally like loans issued in the banking sector in Peru. Yeah.
Sorry, in the table, is this same case? So in Chile, for instance, that data is from...
This is a financial soundness indicator that I got the data from, and it's going to be the share of loans denominated in foreign currency. And my understanding is this is from the banking sector.
Oh, so domestic banking sector.
Local, meaning like it doesn't need to be, it can be a foreign bank in the country.
Okay.
Yeah. So I don't know if it's exactly compatible, but yes, this is the idea. Here we have much more disaggregated, so we can tell. So our sample is going to have all loans issued in Peru's banking sector in dollars or soles, which are the only two currencies we observe. And this is going to be some pictures that help us drive the point that this dollar credit is being allocated to firms that are not naturally hedged. This is not only like exporters borrowing in dollars to finance their exporting or having some type of matched balance sheet. Here we see this in this orange and green line. And we see that it separates firms between exporters and non-exporters and sees the share of dollar credit. Here we can quickly see that this is not just exporters trying to match the currency of their revenue to their liability. While exporters have a slightly higher share of dollar debt, non-exporting firms also borrow in dollars a lot. In Peru, we actually can do better than that. This is the other graph with 3 colors. We separate it by sectors. And regulators in Peru, they understand that while banks can match the currency of their balance sheet, corporations might leave their balance sheet unmatched, meaning their revenues and their debt might be in different currencies. Therefore, the regulators makes banks classify their borrowers or each loan in terms of their exposure to foreign currency. This classification is going to take into consideration the currency composition of their revenues, any financial hedges that the firm might have, and it's going to classify these firms into very exposed, which means that they would default if there is a 10% depreciation of their local currency, and exposed, which is that the default if there's a 20% depreciation. So this is this darker orange or pink type of lines and lighter pink. And we see that across all sectors in the economy, there's a large share of firms being exposed to exchange rate risk because they're borrowing in foreign currency. They're having their mismatched balance sheet. And the other thing, we're going to be using this measure later to see whether the banks are actually controlling for this risk. So now let me show you exactly the rates that firms are paying, which actually explains why they're borrowing in dollars and their preference for dollar borrowing.
Juliana?
Someone's stopping me. Yes?
Yeah, I'm Benjamin from the central bank. A question, when you talk about usually like exchange rate risk, is like an exogenous movement of exchange rate. But if the sales of the business cycle is correlated with the exchange rate, then it's not necessarily that risk, because maybe in bad times the sol depreciate. So I wanna have this is an automatical hedge because my debt is it you know, if I have to pay in soles and in bad time the sol is worth less, then it's good for me because in the bad time I pay less. So in that sense, if the dollar and the sol
that would only be true if you're an exporter.
Yeah.
So you're saying for an exporting firm, it's better to borrow in local currency because this exposure to exchange rate risk will make that their debt is cheaper and their revenues are higher.
Yeah.
True, but that's not the story here. The story here that we observe is that a lot of firms are borrowing in dollars, and most of the times, in bad times, the dollar becomes more expensive to purchase, which exposes them to additional exchange rate risk. Right.
No, yeah, that was a comment about the exporters guys that you say that should be more matched than apparently it's 50-50 or pretty much that.
So for exporting firms, when they borrow in local currencies, when they take the exchange rate risk.
Yeah.
Right.
But I mean that it's on one hand it's exchange rate and in another hand is a exchange rate hedge if the business cycle is correlated with the exchange rate.
Right. We're going to separate our samples across rates for exporting and non-exporting firms. So it's all going to be there as well. So we're able to control for there be a differential behavior. So that will be controlled for. And what we're going to show is that there is some discount and there's some in the way that you would expect that for exporting firms is going to be cheaper to borrow in dollars than non-exporting firms. But it's nowhere near the magnitude of the actual dummy that only considers the firms overall, right? Okay, so the regression result that I'm going to show you in a couple of slides that I was just describing that actually captures the cheapness of the dollar borrowing it's going to feed off of this graphic observation. So this is a good summary of what we're going to do in the paper. So here there are 3 lines. All these lines are differentials, meaning cost of dollar minus cost of soles. So if it's negative, it means that dollar is cheaper. The top dashed line is the difference between the rate charged credit in dollars minus the rate charged credit in local currency in the banking sector. So these are all loans issued in Peru. And here we already see this evidence that we were highlighting, this 2% discount on dollar credit. In a minute, I'm going to do a better job to show you that this is going to survive even after we apply many controls and account for exchange rate movements. The next line, the blue line, is the difference between deposit rates in dollar and soles in Peruvian banks. And here we see the second point of the paper, which is going to tell you that the reason why we see this cheapness of dollar loans is going to be because there's a cheapness of dollar financing through deposits for the banks, and the banks are going to have to pass this through because of regulation. What we see is that these two lines are going to be tracking each other pretty well and seem to be feeding off of each other. The last line is the differential in the central bank rates in Peru and in the US. And this suggests that if you're going to think about, uncover different UIP deviation, the traditional way where we think about like macro rates, it's really not going to really observe, you're not going to capture everything we observe. So basically, I'm going to start showing you this message in a very careful way. I'm going to start by measuring the dollar discount using this granular loan level data interest rate that we observe. So first, we're going to run a regression that measures the raw difference in the dollar and local rates, similar to the dashed line I just showed you. The dependent variable here is going to be interest rates for loans denominated in dollars and soles. The dummy that we have right here is going to be identifying a dollar loan, and it's going to be picking up at the dollar differential, the level of cheapness of the dollar loan when it's negative, right? If it's negative, means that the dollar is 2% cheaper. That's kind of how we read this rate right here. So the first three columns are going to have different combination of fixed effect. It's not going to be reported in the table here, but in the paper it is. You're going to see how careful we are in our exercise. We have many loan and firm characteristics, industry quarter fixed effects, bank quarter fixed effects, and firm fixed effects. So if you believe in bank specialization of any type, this should answer your concern. So here we see that even for different combination of fixed effects, the dummy changes very little, which gives you some confidence of the robustness of the result. The table is not going to be fully reported here, but in the paper, you're going to get a sense of it. The last two columns are going to separate, as I was telling Benjamin, the exporters and the firms that are exposed to see if there's any additional costs for exposed firms and further discounts for exporting firms. And there is, but it's nowhere close to the magnitude of the 2% discount. So it's indeed that exporting firms, it's cheaper for them to borrow in dollars, as we would expect, because they are in a way naturally hedged, so they have less risk. If there's a depreciation, they're less likely to default. And also, if you're an exposed firm, you're going to have an additional cost of borrowing in dollars because you're going to default. And exposed just means that you default if there is a depreciation of 10 or 20%. If that's the case, then it's natural for the bank to charge a premium for the dollar loan, and they do. But it's still cheaper to borrow in dollars. What I'm going to show you in a couple of slides is that this dollar differential on firms that are borrowing in dollar and soles at the same time, which, as I was saying before, in the lab experiment would be kind of this perfect experiment controlling for any type of firm characteristics that we do not observe. And we do have a few firms that are like that. And what we see is that still, although we lose a large part of our sample and we fear that this might be a particular type of firm, still it's much cheaper. The results hold. It's about 2% cheaper to be borrowing in dollars. Of course, you can tell me, Juliana, these two rates do not need to be identical. The 2% differential could just be a reflection of the expected depreciation of local currency, meaning it's cheaper to borrow in dollars because the dollar is expected to appreciate. So it's going to take more soles to pay out your dollar loan. And so what we're going to have to do is that we're going to have to control for exchange rate movements, meaning getting a true UIP deviation instead of just interest rate differential. So what we're going to do that we're going to use survey data. So we're going to adjust by creating a new dependent variable, R adjusted. If it's in a local currency loan, the rate just stays as it is. So if it's a soles loan, it's just the soles rate. We're going to create a synthetic soles rate coming from the dollar rate. So it's going to be this R adjusted here, where we adjust the interest rates in dollars by the expected depreciation using survey data, using Latin focus. And we're going to run the same regression, but now the dependent variable, when the credit is in dollars, is going to be adjusting for expected depreciation. So this is exactly what we do here. We do the same regression as we did before. Again, we're going to focus on the dollar dummy, and we see that the dollar discount stays around this 2% ballpark. Therefore, it's indeed the case that even when we account for exchange rate movements, borrowing in dollars is significantly cheaper. Column 3, which has the full array of controls, shows that the dollar rate is about 2.15% lower. In the last column of this table, we also add the standard deviation of the expected exchange rate, which we translate as the standard deviation of the universe of forward contracts that have the similar maturity and a similar time of issuance as the loan contract. The idea is that this second moment, the volatility, the standard deviation of these forward contracts, is going to be capturing uncertainty over the future exchange rate, right? So do we expect the future exchange rate to be very volatile or not? And we see that the larger this uncertainty is, indeed, the larger is the dollar discount. So you can think about this as, you know, the higher is the uncertainty, the less firms want to take these loans in dollars, but the more the bank is willing to give you a premium to make you take these loans in dollars. But what happened is that this impact is small. As the volatility doubles from 0.1 to 0.2, which is 0.1 is the average in the sample and 0.2 is the highest value it ever gets, the premium only increases by 10%. So we also adjust by the observed rates instead of the survey forecast, and we showed that not only were firms expecting the dollar to be cheaper, but it was exposed cheaper. Next, we do the same, continuing using the adjusted rate, but now we do it for firms that are borrowing the same quarter in dollar and in local currencies from the same bank. So this is going to be our within firm analysis that I was just pointing. The results are going to be very similar, although we lose a large part of our sample. And we worry that firms that are borrowing from the same bank in the same quarter, it's in dollars and in soles, might be a particular type of firm. But this is common practice because it specifically controls for any type of unobserved time varying borrow heterogeneity. And the fact that it's similar to the previous results tells us that our results are quite robust. So we show you so far that in Peru, dollar borrowing is significantly cheaper. And I'm going to soon do a better job of tracing this cheapness through deposits. But now I'm going to show you some numbers for other Latin American countries that points that this is a broader phenomenon. So here we hand collect deposit rates for a set of Latin American countries that allows for dollar deposits or foreign currency deposits. Column 3 displays the average difference in deposit rates, showing a large discount on deposits. And then column 4 adjusts these deposit rate differential using expected exchange rate movements. And what we see that even accounting for expected exchange rate movements, depositing in dollars for the depositors actually has a lower return. Furthermore, we compare it to monetary policy rates, columns 5 and 6, and we see that the discount we see in deposit rates is significantly larger in magnitude. This implies that in the more traditional way that we calculate the UIP, that usually we just use government financing rates and carry trade, might be masking the true magnitude of the benefit of the dollar loans. And that's why sometimes when we just use these rates, it's hard to match what we observe in those prices to actually what we see in the markets. So in Peru, we actually test whether government financing UIP explains the discount we observe in loans using our granular type of data. And although the variable of the UIP is significant, it does not justify the size of the discount. So it still stays there pretty significantly and in similar size. So although government UIP is capturing some of the dollar discount, it looks like there's something there also that doesn't explain the total size. So what we think is that what is explaining this total size is actually deposit premium. What we see is that the deposit differential here we plot is actually deposit rates are much lower in dollars than in soles than the cheapness of dollar financing in dollars and in soles. In this plot, we also adjust the government financing rates using MB to adjust for country risk. So what we find out so far is that the magnitude of the dollar discount that we observe in loans is too large to be explained by country financing rates. And actually what we see here in this plot, but also in the graphs that I showed you before, there's this pointing towards the fact that this is connected with bank deposit financing. So then for the rest of the talk, I'm going to focus on banks, and I'm going to try to think about from the bank's perspective, why is it that they're passing through this cheapness in the deposits to borrowers? Is it a regulation, and is it the combination of regulation with the deposit inelasticity? Is there a question?
Can I ask you, Juliana?
Yeah, yes. Who wants to go first? I'll choose Alvaro.
Okay. So these are large films, right?
So the what we observe is on average the larger firms.
Right.
Yes.
So what if you can only lend in dollars to large firms and in soles to every firm, and you know that the big firms are the good ones, and then that's why the interest is lower for dollars? Is it possible?
So that would we control for the size of the firm, and we still see that this does not capture everything.
Right, but the size inside this group that it is.
So what Alvaro is saying, I don't know if that's what you're saying, but so for the very small firms, we don't observe their loans just because of security reasons. The bank does not allow us to work with that data. But what we see is that even for the large firms, their risk changes. So I'm going to show you in a minute is that as the more these firms become riskier, more prone to default, they're more likely to borrow in dollars. So even if that was correct, it doesn't look like the data supports that conjecture. So, and this is going to be true because it looks like the banks are not actually pricing for this default risk. So what the story we have in mind and what the data supports is that the banks have so much pressure into giving dollar loans because they need to match their balance sheet due to regulation, that they end up even not pricing currency risk or any type of default risk in their interest rates. And this is why we see these rates being cheaper. Okay. So our story is that it's coming also from a regulation that the bank imposes, that it's imposed on the banks that makes them not charge this risk.
Okay, but then you should observe also that the banks should be more should be raise the interest rate on pesos more in soles, sorry, more than that spread, right? If you're in some sense restricted to this regulation, then you want more soles, and maybe the spread that you observe in the deposit should be even larger.
It should be, but I mean, always there is a zero lower bound for the. I mean, they can charge fees and everything, but we do see that there's a spread in the deposit rates between dollar and soles, and the spread is going to be very connected. I'm also going to show you now. Because we're going to start trying to trace this back. So a lot of your questions will be answered. We're going to start to trace this back. So the first part of what I showed you so far tells you that, borrowing in dollars is cheaper, much cheaper, which explains why we observe. Now, the second question, which is attached to the questions you're asking, is like, why is that? It's so much cheaper, right? Usually we think about this as saying this is just aggregate UIP driven by macro factors or country risk or some type of, monetary policy. And if that was true, then government financing rates would be capturing a lot of this, right? And what we see is that it doesn't. And the reason that it doesn't is actually this is not coming from like a macro aggregate financing, but this is coming from how banks finance. And their banks are financing with deposits, and together with the deposit financing, together with the regulation, is leading to this pattern. And then I'm going to start working really hard. This is now the second part of the talk where I'm going to start working really hard to convince you of that story.
Okay.
So what you should have known, like now, the story you should know is that it's cheaper. It's not a selection of like very good firms because we control for risk and we also observe some other stuff on risk varying. It's not aggregate coming from like financing rates of governments. It's actually coming from these deposits. And I'm going to start now showing you this picture. There were some other questions.
Yes. Hi, Juliana. Andres Fernandez here from the bank. So I arrived a few minutes late, so I don't know if you've mentioned already regulation, right? Because it looks like that's where you're headed. Because you're discarding firm size, which is, I mean, according to some papers around there's these size-dependent constraints, which might lead you to think that these are bigger firms that are taking advantage of this, but you're discarding this, okay? So it looks like this is like an unintended consequence of regulation, forcing these banks to be matched.
It is, together with a deposit preference. So this only bites if there's a preference for dollar deposits. So the regulation only bites if there's a preference for dollar deposits, and I'll show you how. And I also want to say, it's not like I think any type of size, or even I myself have proposed productivity as a measure of who takes this risk. All of these things would still work if banks don't have this regulation on top of them that makes them not be able to price these in, because they have this pressure really strongly coming from regulation. So it's not that I think these things don't matter. I think these things don't matter in the way that there's combined with regulation from a huge pressure of depositors' preference for dollar deposits, together with a regulation that doesn't let banks be mismatched. So no mismatch without the deposit preference doesn't work, and deposit preference without a mismatch regulation also doesn't work.
Okay, yeah, so you answered my follow-up question. So why are dollar deposits so cheap in Peru or in other countries? It's just a preference. So this is you're explaining, and perhaps it's related to pressures on inflation, whatever.
I mean, we're not going to be able to go there so detailedly because we don't have disaggregated level data on deposits. So, you know, as you guys all work in the banks, a lot of you know that like a lot of times they cannot disclose this information because these are, you know, they cannot disclose. We have some level of breakaway of like if it's households or firms and the maturity. So I'm going to be able to go somewhere in that direction. So don't think about this as only being households or only being firms. It's both. It's actually the majority of the premium is coming from term deposits, and those are firms. So it can either be, you know, and we're not going to be able to disentangle the story, but you can think about this being kind of the Boccola, Lorenzoni, AER paper story, that this is depositors or households' preferences for dollars. This could also be Gopinhart and Stein's story about these being firms that want to keep their cash in dollars because they have payables in dollars or something like that. Okay. So we're not going to be able to disaggregate to that level, although I wish I could, because the data on depositors cannot be shared. We cannot work with that. But it's basically those two possibilities, right? Okay.
Sorry, I have a question now.
Yes.
So since you said that banks are not pricing risk how they should in dollars, do you see these loans as more? Can you observe these loans to be more risky, to have higher default rates?
It will in a way, not on average, but what I'm going to show you are going to be two things. So I'm going to show you that as there's more higher capital requirements for risky loans, the banks don't pass that through to the loan. So this is where I'm saying they're not pricing it in. The other part that I'm also going to show you is that, as I already said a little bit, is that as firms become more prone to default, they start this kind of gambling for survival type of behavior where they start borrowing in dollars. So those are two things that we do observe. But on average, because this is, you know, a lot of firms and some of them are, so you cannot generalize, but what I can say is that there's going to be some of that behavior as well. I'm not saying that all firms borrowing in dollars are risky. This is not at all. I think if anything, there's going to be a share of them that are very safe, and there's going to be a share of them that are risky. So yeah. Okay, so now, as I was pointing out, I'm going to start trying to explain what drives these 2% dollar discount we observe. And what I was already pointing at, this is coming a lot from the bank's perspective. So we're going to dive under the hood of banks and talk a lot about regulation, banks' balance sheet, and all these fun things. So we know that generally banks do not carry forex exposure in their balance sheet because there are capital requirements attached to it. But in Peru, as in many other dual currency or multiple currency type of banking sector, we see a tracking of assets and liabilities. And this is incredibly tight for Peru, as you can see here. This is dollar liabilities and dollar assets, both for all banks and foreign banks. So the reason for that is, as I was saying, regulation that is rather typical and actually makes it very expensive, you can even say prohibitive, to carry a mismatched balance sheet. So here we provide an example for Peru. If you're exposed $50 in loans, so if you have $100 of loans and only 50 of these dollars are coming from deposits in dollars, you're going to need 2 times the exposure. If you are exposed $50 in deposits, so you have $50 more deposits than loans that you're giving, you're going to need 10 times the exposure. So it's quite prohibitive in terms of cost to post capital to hold a mismatched balance sheet. And this is why we see in the picture I showed you before, this close tracking. So as I was pointing out, this starts building this narrative that ties together the fact that the discount we're observing in the deposits are going to start popping out on the loan side. In absent of regulation, you could think that the bank is going to keep the cheaper financing in dollars coming from deposits, give soles loans, and make the carry trade profit themselves, which is something that when I was looking at only firms in a previous project, everybody asked me, why don't banks do it? And the reason is very simple, is because they can't. But this regulation that are put in place to prevent banks from taking forex risk, if you remember in like 80s, 90s, there was all these like dual twin crises of banking and currency crisis or foreign currency. It was coming from banks having this mismatched balance sheet. So then this regulation became very typical to prevent that. And it makes, what happens is that in the end, what happens is that the banks, when they have this pressure from deposits, they end up giving it out to loans. And what I show, and I was kind of describing it, is that this pressure is high enough, is going to make banks take forex risk indirectly. Because in the end, they're giving it to corporations. They're carrying the forex risk in their balance sheet. And this is going to, in the end, generate, if there's a corporate crisis, it's going to make a balance sheet crisis indirectly because the banks look matched, but they're matched with the risk, right? So the last piece I need to show you that this makes sense is to show that deposits are a primary source of funding in dollars for these banks.
May I ask you something? Because the regulation is true that you cannot have mismatches in currency, but also you have, at least in Chile, I think in other place, that it depends the currency, the risk of to whom you are lending. So that's and that's taking account the mismatch of the debt of the firm level. I think Chile exactly like that. So because it's clearly what that happens.
So there's a little bit of that. So there's additional capital requirements if you're lending to a firm that is exposed, but it's very small. And also what we see is that the banks are actually not passing through this cost to the firm. So in a way, they're not fully accounting for this risk. So you're right. So I think if you borrow in dollars, the capital requirement is about 10%. If you borrow in dollars for an exposed firm, it goes from 10 to 10.8. So it's minimal. But there's some, you're right. So it's to prevent this indirect risk taking. But I think in the end, what I want to show is that still there's a large share of the loans that are going to be for risky firms, or risky in terms of a dollar sense, in terms of defaulting in dollars. So you're right that there's some regulation, and we're going to use a change in this requirement actually to measure whether banks are capturing that. So yeah. Okay, so this is what I'm going to show you here is that to make the story that this is coming from deposits together with regulation, is I need to tell you that a large share of the dollar is coming, dollar financing for banks is coming from deposits. And this is exactly what we show here. We see that about 70% of the firm's dollar liabilities are coming from deposits. And this is going to, and this is true across a lot of emerging markets. So another way that you could have dollar liabilities would be through foreign liabilities, right? Some type of money market funds. And we gather some data for many countries, and we see that the majority of the dollar liabilities for a lot of emerging market economies are actually coming from deposits and not necessarily from foreign liabilities. So for Peru, only about 10% is from the total assets are foreign liabilities, and 55% of total assets are deposits. There's no breakaway between dollar and soles, but overall, you can think that a lot of the foreign liabilities are in dollars. In Peru, actually, we can break them, and we see that, this is true across many banks. So it's true that a lot of the deposits are going to be the source of dollar liabilities for banks. And this matters because you can think that the cyclicality of dollar deposits is very different than the cyclicality of foreign liabilities. So there's a lot of papers that think about in the concept of Colombia or in the concept of Mexico that do not allow for dollar deposits to the way that, Peru allows for. There's a lot of regulation attached to it. If it came from only foreign liabilities, then you're going to have that the cyclicality of capital flows in bad times, the dollar foreign liabilities goes away. In deposits, in bad times, the dollar deposits actually goes up. So it's going to increase the pressure in the banking system in bad times. And that's going to matter, right, in terms of how we think about the effects of these currencies. So
may I ask you another question?
Yes.
Why? Sorry if I lose something, but you can have exactly the same thing. But saying that there is a preference from firm to have dollar lending, and you will have exactly the same graph.
Yes, but I think if the firm has a preference for dollar lending, at least in my brain, when I think about, I'm a theorist by trade. So if the firm has a preference for dollar credit, they will be willing to pay a higher dollar interest rate to hold dollar credit. And so we wouldn't necessarily be seeing this lower interest rate in dollars that we observe in equilibrium. Also, so for the firm to hold this, if it has a preference for soles because it doesn't want to be exposed, you need to pay a premium. If it had a preference for dollar, then you wouldn't need to pay a premium. The banks would be actually keeping more of this carry trade profit themselves. And the fact that the banks do not keep the carry trade profit themselves implies that this is coming more from the bank's perspective of needing to give the dollar loans than from the firm's perspective to wanting to take the dollar loans. Does that answer your question? And I have, it hasn't made to the presentation of the paper yet, but I have played with toy models to show this. And it's kind of cool because, it makes sense mechanically. So this is why once we look at the interest rates, it tells you whether this is coming from the loan side, from the wanting to take the loan or from wanting to hold the deposit together with the banking having this regulation. So to summarize, so far we have shown that there's a large discount in dollar credit. We're claiming that this seems to be tied to the cost of deposits. We have also shown that due to regulation, banks do not carry 4x exposure in their balance sheet. So what we claim, and I'm showing this in a model that is not here, but I'm happy to talk about it later, is that it looks like the key to understand the dollar credit is to understand the demand for dollar deposits, right? We need to understand why, if these depositors are very inelastic, and this is why we see this pressure coming to the banking sector that needs to be released by giving these loans in dollars. So to provide additional evidence of this channel, we're going to use changes in reserve requirements on dollar deposits to test for the elasticity of the dollar deposit demand from the depositor perspective. So here, an increase in reserve requirement is going to decrease how much depositors the bank can lend, and it's going to increase the cost for the bank of holding these deposits. Reserve requirements on dollar and local currency deposits are treated differently. We use these differential changes in the marginal reserve requirement to identify these plausible shocks to the effective cost of dollar financing from the bank's perspective. The basic idea is to understand the elasticity of dollar savings. During the period we studied, there were a few big changes that we're going to focus on. What we're showing here is the changes, is the differential in the dollar versus the soles reserve requirement. We're going to look around 2 periods in our sample, highlighted in red and dated. The top ones are 2014 and beginning of 2015. These are 2 massive asymmetric increases in the dollar deposit reserve requirement. So it increases, 2 increases by 10. It goes from 50 to 70 on the marginal. And then in the end of 2016, you have this big unwind in one stroke. You can ask if there's something weird going on in the exchange rates, and what we're showing here is that it doesn't look like it. We're going to now relate these to deposits over time. So a rise in reserve requirement can be absorbed by depositors and or by borrowers. At the limit, if the demand for dollar savings is so inelastic, the adjustment is going to show up as a contraction in the deposit rate without any movement in quantity. We will next test these rates and quantities in response to these changes, but here's going to be a visual of our results. We're going to aggregate 2015 and 2014 together because they're tracking each other. These are 2 sequential increases of 10. And the line that moves up is this increase in reserve requirements. It goes from 50 to 70, the differential in dollars. And we're going to argue that there's reasonable exogeneity about the quantity of the shift, as the size of these changes were unprecedented in the sample for Peru. The result I'm going to show you in the next slide can be easily tracked on this picture, which is that this pressure is going to be absorbed mostly through the deposit side as a drop in deposit rates. And also what we see is that this is across the board for all banks. So there's no like bank specific type of shock that we're going to be observing. So here's going to be exactly that same exercise. So we construct what I showed you in the graph, but now in a regression form. I construct a benchmark for interest rates. We assume that the compensation for reserve is 0. This assumption actually might bias our results against us. The demand for dollar deposit is completely inelastic. This benchmark would imply an adjustment for deposits due to the reserve requirement increase equal to 0.27 in the increase and 0.55 in the decrease. So we should see that deposits drop 0.28 when it goes from 50 to 70, the differential increase in the reserve requirement of 20. And when it goes from 70 back to 48, it should have increased about 55. And what we observe are regression results yield, especially for the first episode, changes in the rates that are statistically indistinguishable from this benchmark. These results are consistent with a highly inelastic demand for dollar savings. So this evidence on deposits being inelastic, driving the cheapness of the dollar financing from the banks, from the inelastic demand for dollar deposits, together with having to comply with this regulation, having this matched balance sheet, going to push this into borrowers, potentially exposing them to risk. So next, I'm going to show you that this push can lead to borrower risk-taking, especially if it seems like banks are not pricing it, which we think they're not. So here's the first thing that I had already talked about. And we see the probability of obtaining a dollar loan as credit changes. On different horizons, we are looking at deterioration of the quality of the borrowers measured by past due loans and the internal credit rating. And we're showing you that as the quality deteriorates, borrowers are more likely to take on dollar loans. This is consistent with the fact that with the need to match the balance sheet, banks are going to not be pricing in exchange rate exposure. We have already seen this in the original pricing exercise that we did, the first couple of regressions I showed, that showed that if the firm was exposed to exchange rate risk and the bank knows the firm is exposed to exchange rate risk because the bank classifies it, there's an increase of 20 basis points on the rates. And this increase is quite marginal. If you think 20 basis points, this is the risk premium they charge for a firm that's going to default. It's very small. To drive this point home, as I was thinking already, as I was talking already about it, we're going to use changes in the capital requirement to show that beyond not pricing it, the banks are also not provisioning for this risk. So we have episodes where the capital requirement for exposed loans that the banks classify as defaulting in a 10 or 20% depreciation, is shifted. This is this dummy of a post right here. And we see that the increment is relatively small. It goes from 10 to 10.8, yet this increment in the capital requirement is binding. And so it makes that then once this capital requirement increases is only when the bank starts kind of pricing this in. So this is consistent with the fact that the banks are somewhat playing the role of not accounting for the risk internally because they have so much pressure from the depositors together with the regulation to actually give these dollar loans. And because the firms don't want the dollar loans, they need to have a much lower price for it so that they take it. We do not find
Juliana?
any evidence. Yes?
Juliana, sorry.
Yeah.
What is the best benchmark do you have in mind in order that your paper get some social impact in the academy?
What do you mean about benchmark? Sorry.
I guess that you can improve these numbers using monetary policy in Peru, for instance, because we have some kind of mind. I know Ecuador, and I guess that cryptocurrency it's a main point here because we observe some changes in monetary policy here. If you compare the data along the time.
So I think like if what is the message that I want, like the policy?
Yeah, what do you have? What do you want? What is the main?
Okay, so there's a lot of
suggestions about the monetary policy in Peru, for instance.
In terms of monetary policy, I'm not sure.
benchmark.
I think what the message I want to take away, it's kind of the idea of we're so worried about corporate loan dollarization. But actually, corporate loan dollarization doesn't come from firms' desire of dollars. It comes from pricing. And the pricing is coming from the regulation you impose together with this desire for dollar loans, for dollar deposits. So if you want to do something about having, corporate loan dollarization lowers, you need to actually think about depositors together with the regulation and not really think about the firms themselves, right? So like don't treat the firms, but treat the actual cause, which is depositors. And why? Then you need to start investigating why is it that depositors are having such desire for dollar loans? Is it because they're afraid of inflation? Is it because a lot of their inputs are dollarized? I'm not sure. I don't have an answer to that. But I think that the message I want to say is that, look, the loans the pricing doesn't have an origin on aggregate outcomes that you can't control. It has an origin on very local types of components, which is the people that are holding these depositors. So, if you want to do anything about it, start regulating deposits or start, trying to kind of give sweeteners or any type of, benefits for holding a local currency deposits. The other flip of the coin is, for example, for a country like Brazil, Brazil is now starting to allow, it's having regulation to allow for a dual currency type of banking sector. They just passed a regulation. What I want to say is, like, if you're going to start allowing for dollar deposits or foreign currency deposits, given that, domestically there might be a strong preference for that, you're going to run into trouble later because you're going to have a lot of loans being given in dollars as well. So just be aware of that. And it's not like dollar loans are bad. Actually, I think dollar loans or foreign currency loans, because they're cheaper, they're good. But as long as they're being given to the right type of people, right? You want positive selection. You want these loans to be held by these firms that can carry this risk. But to have that, you need to have that the banking sector doesn't have so much pressure in matching their balance sheet. Because if they do, as we see in Peru, what's going to happen is that they're going to end up giving these loans to firms that default. And that generates, if there's not correctly provisioned for, it's going to generate problems.
Okay, but what about in Brazil? What about dividend policy, for instance, because it's different here in Chile.
What do you mean? Sorry, what about what?
Dividend policy.
So these are not necessarily
in particular in these pandemic times. So
you're thinking about
we can
corporate
move
dividend.
this kind of regulation in order to get some money.
Dividend for firms. So these are not necessarily listed firms. So I'm not sure, like very few of our firms are listed. So this is not only, these are not like debt or listed firm problem. I think, so I don't really have much to say about the dividend policy themselves.
Hey, Juliana?
Okay, thank you.
Yes, yes.
There are 15 minutes left.
Okay, I'm almost there. So because I planned for an hour and 10, an hour and 15. So we did not find any evidence that bailout expectation, which is a common explanation for banks having this type of risk behavior or lack of pricing of risk, being explained by this. When we restricted for the largest banks, which would be the most likely to be bailed out, we still don't see this being any different from the smaller ones. We do find some evidence that older firms with more bank relationships, kind of this type of coveted firms, do get a better discount. So there's something to talk about the competition channel of the firms. These firms are saying like, oh, you really want me to take this dollar loan? Then give me a better discount because, you know, I don't really want to take this risk. So let me just kind of sum up, but I think I gave some of my insights already. So we studied this important credit of understanding why dollar credit is so prevalent. And I think to a sense, you know, this hasn't been fully understood, and it's starting to be fully understood now that we have better source of data. We're understanding the consequences of regulation we put in. We showed that this magnitude is large, so dollar credit is very predominant because it's very cheap. So it's coming from the fact that the price is there. And what explains this preference is going to be that this 2% magnitude is coming actually from deposits from bank financing and not government rates. You may ask, what drives the deposits and the discount? And we have suggested evidence to saying that this explanation is coming from preference for dollar savings together with this banking regulation, which leads to this enhanced carry trade that is going to end up being intermediated by banks. So this is all I have. Thank you so much for everybody tuning in. I'll be here for more time. If there's any discussion, I'm very interested in hearing what you guys have to say.
Thanks a lot, Juliana. We have a few minutes, about 10 minutes or so, to further discuss a couple of questions. So if you guys want to ask something, please feel free to ask Juliana anything you have in mind.
Please, Dr. Acosta, I would like to ask a question to Professor Salomao, please.
So formal.
Go ahead, please.
Professor Salomao, well, please, I've got two things. First of all, what is the participation of U.S. dollars in the foreign currency deposits in Peru? I mean, has there been an increased participation of either euro or Chinese yuan in the foreign currency deposits and loans in Peru? And secondly, could there be that Peruvians, they have their preference for dollars and for deposit their monies in dollars, given the history of hyperinflation that they've got in the late 80s and early 90s? Please, I would be very grateful for your answers.
Okay, so we don't observe any yuan or euros in the deposits. It looks like I don't think, so I have asked this question a couple times to my co-author who is in the banking regulator, and he is only dollars. And here, I think it's kind of, so this is borrowing. So I don't have a picture for lending, but I thought I did. Okay, so it's about 40 to 50% of the depositors. I think I have here. So the deposit, the shares by currency. So in checking deposits, about 34% is in dollars, and in savings is 25, and in term deposit is 41. So it's, you know, quite significant. And it is attached to inflation. So what we saw is that once inflation started being more under control, we saw, you know, from the 90s on, we did start seeing a decrease in the dollarization of deposits. But it's also attached to risk, you know, as the 2018, the QE and all these things start happening, you start seeing a reversal as well. So it's attached to inflation, is attached to uncertainty. So definitely there has to be some type of like reserve of value being attached to it.
Thank you, Professor Salomao.
Very few people call me Professor Salomao, but thank you. We are less formal in the US than in Chile, I'm sure.
So I have a question, Fernando here from the central bank. So I'm wondering, how are you ruling out the story of just the exchange rate is correlated with how the economy is going out there? I mean, if it's bad times for everyone, for banks and for the guys getting the loans, so, and that could explain, like, I don't know all, but like a big chunk of that differential in.
So we have time fixed effects. We're not ruling that out, right? So a lot of our regressions will be captured by that. We do have like industry quarter fixed effects, bank quarter fixed effects, borrower quarter fixed effects when we do the within. So we're not ruling it out.
Well, you say the differential you're calculating, it's only among you're already like different that part out. That's what you're saying.
Yes, it's not explaining it, so it's not exactly that part, right? So it's still, I'm sure it's there. We control it to the best of our abilities to get this average out, but you know, we're not ruling it out. I'm sure it's coming. I'm sure it's having some part of the variation coming from that.
Okay, and I find quite interesting this asymmetry on regulation, whether these guys are long or short. In dollars, because that's basically what's happening here. So basically, regulation is pushing the risk towards companies, right? So there's like non-financial, and we upfront we don't know whether that's good or bad. I think that's interesting.
I think you need a model to tell if it's good or bad, but in a way, it's going to depend on the selection, right? And I think it's going to be good if the preference for dollars is such that it doesn't generate such a large share of dollar deposits. It's bad if it generates such a large share that in the end you're not able to satisfy the thirst for dollar loans to have a matched balance sheet only with low risk firms, right? In my head, I think like usually you're gonna try to first get, you know, your better firms, your lower risk, the ones that can account for this risk. But at some point you have such a need to give a dollar loan to be matched that you're gonna take anyone who is willing to do it. And you're gonna price accordingly to make that happen.
Okay, thanks.
Juliana?
Yeah.
Yes, and Andres again. So I find very interesting this idea of mispricing of risk that you're pushing. Who is worse off with this mispricing? Is banks, right? So should we view this as this regulation increasing the fragility of banks, or Ama?
Overall, I think it does increase the fragility of banks, but also like it ends up, there's a case that is also bad for the firms, right? It can be that the firms, it's so enticed to take this risk that it takes this risk, and it's great as long as the exchange rate doesn't depreciate. But if it depreciates, the firm ends up defaulting when it would be better off having taken a local currency loan and not defaulting, right? So it can generate bad outcomes for the corporate sector as well, because you're going to have excessive risk taking there as well.
And along those lines, so I didn't quite get where your sample begins. So what is the period that you're analyzing?
12 to 18.
2012.
2012 to 18.
2012. Yeah. Okay. Well, it's not such a long time, but I was wondering whether there has been some de-dollarization in Peru along these years. I remember some officials.
A little bit, yes. So at least in loans, there has been a push to de-dollarize a lot. So our sample is coming here. So this is dollarization in Peru in terms of borrowing. And so, yeah, a little bit.
Do you see this differential, this 2% differential? Do you see any change between the beginning and the end of the sample?
Not that much. So this is kind of like a good summary is this picture here. So this would be the dashed line. Sure, there's a little bit, but there's no trend, right? There's more cyclicality.
And related to this mispricing of risk, have you looked at episodes of large devaluations?
We haven't had it. I mean, there were some, but not like incredibly a lot during the sample.
Yeah, well, I would have thought the 2014, 15 when commodities
tanked. There was a little bit, but we haven't focused on those periods.
I guess what I'm trying to say is if there were these periods of high volatility in the exchange, what would that trigger, and what would that generate with this mispricing of risk that we were talking about?
It should generate higher defaults. Our goal is not really to look, it's more to look at the bond price and the bank sector, not really looking at like the firm behavior itself. We haven't looked, right? So, but yeah, no, it'll be interesting to see.
Okay.
One more thing, I didn't get. So why can banks just invest this somewhere else, like financial markets outside?
Can. So they can, but they do some, especially at times where the risk is higher, but the interest rate is lower. So like they could just hold treasury bills, right? Instead of lend. But the return they get, the return they get in lending is actually still higher than T-bill, right? So it's still like the 5% that they get from a dollar loan, it's higher than what they would make by investing this in a dollar safe asset.
I mean, sure. I mean, without adjusting by risk, yeah.
Right. Yeah. But yeah. So they need to make a profit in the end of the day. So it's not worth it for them to hold a T-bill, even though they could. But then that would actually make their profits lower. And
going to an S&P 500 is you don't see that.
We don't see that. I don't know. I mean, the whole, I know that they cannot hold, treasury bill, or they can hold safe assets. I'm not sure regulation if they can hold. I never seen a bank holding equity. You guys people in this might know this better than me, but I don't think banks can hold equity.
Yeah, I'm not sure about regulation there.
I don't think they can. I know that there's a lot of, it's a good question. I ask, and the answer I've been told is that, you can hold other types of safe securities in dollars. My guess is that to be matched, it doesn't need to be any type of dollar asset, but it has to be some type of dollar asset. Like there's regulation over which ones.
Yeah, and also different capital requirements for them, for sure.
Correct. Yeah.
Okay, thanks.